One of the best ways to scale a business is to raising finance through investors. That's exactly how billion-dollar businesses get created, because they raise money, they invest it into growth, and they end up scaling their business. I know this because I have raised over $20 million for my own business, Gemflow, and our portfolio businesses. So in this video, I'm going to break down for you the 5 different levels of investors and how you can raise from each one of them, so you make sure you pick the right one. But look, just before we jump in, it's very important to note that we're not talking about bootstrapping, because bootstrapping is not raising money. You're essentially using your own personal money. This video is not about bootstrapping as a way to finance your business. Number 2, loans. No one ever should be taking out a loan to start a business. That is the worst way to start, because you're ultimately starting in a negative position, because you could go through the different 5 types of investors, the 5 different levels, and you can find the right investor for you and use their capital to grow your business. Exactly like how I did. I raised $11 million in 2021. I used that to 5x my business. So look, the very first level is called angel investors. This is your traditional, what you see on Shark Tank or Dragon's Den in the UK. Essentially, it's where you are going to find high net worth individuals, i.e. angel investors. You know, they're an angel in your life and they're going to come and give you some money. This is the easiest way, because ultimately you are going to people with money and you're getting them to help you, back you to go ahead and start your project or finance your project or give you money to scale your business. I did the same thing in 2014 when I left my job. After I built my MVP and we had some users, I raised $50,000 from an angel investor. How I physically did that is that you can go to websites essentially where are all about angel investing. One of the biggest ones is angellist.com. Essentially, I went on there, I listed my business and what I do, and angel investors start contacting me. After a few meetings, one of the guys ended up investing in my business. So essentially, you are looking for an investor that wants to invest in your category, is interested in your business, and you can go ahead and find yourself. Today, you can do this on AngelList very easily. On AngelList, you can go and search for different investors. You can see what they're investing in. You can message them, etc., and you can start to do that. The other key way to be able to get people's attention would be is that go and follow them on Twitter, engage with them on LinkedIn, and try to get them to realize that whatever thing they're interested in, you actually know about, so you can position your business. The truth is, to a lot of people, you can even cold email them and you will get a response if you do a good job. I would recommend that you can do a small email which states the top line numbers. For example, you can say what your business is, who's it serving, current traction, what you're raising. That is it. If you send that in 6 bullet points, even to me, I would most likely respond, because I angel invest into businesses in the same way today. One of the most famous angel investors of all time is a guy named Jason, who was the angel investor in Uber. And the way he found that is an exceptional story. Essentially, he was waiting out to get a taxi, and this guy next to him was using this app to call himself a car. And he goes, "What's that?" And essentially, it was a founder of Uber. He ended up putting, I can't remember how much, a very small amount of money into Uber, which made him an insane amount of return. So angel investors like to play the game of high risk because the reward could be absolutely ginormous. It's a bit similar to the journey of Facebook. In the beginning, someone put money in and had a massive return at the end. One thing to be careful though when it comes to raising money from angel investors is that we're not looking for your classic old school business guy who's going to be like, "I'm going to give you 100,000, but I want 10,000 per month back. What's my dividends, etc." When looking for angel investors, you want to find people that don't want their money back in payments, are not looking for dividends. They are only looking for a big exit return. And you're looking for someone that genuinely is like, I love your idea. I'm going to support you. And when you sell, I will make my return. Or if you raise again, I may sell my shares at that time. My initial angel investor ended up exiting when I raised $11 million later, because he was going to make enough of a return. So he's like, "I'm happy. I'll take my returns. Thank you so much." So that's to be very careful not to go and raise money from like rich people who are going to like screw you. Make sure they're genuine, bona fide angel investors and they actually want to do it for the right reason. So the second level from there is accelerators. Here it's a little bit different. So you would go into an accelerator and they would normally want to take 7 to 10% of your business for letting you join the accelerator. And in return, you're going to get 4 to 6 weeks of intense learning. And essentially, they're going to give you the network and the support to really incubate your idea and get it going. This is obviously one of the oldest ways to do this, and it's very successful. Massive companies have been through like Dropbox, Airbnb, Stripe. So like massive billion-dollar businesses went through an accelerator to fast track their learning. And then from there, they built the network to be able to go and raise further finance in the future. Today, Y Combinator is one of the hardest programs to get into, and they now have the networks. Essentially, at the end of Y Combinator, you are doing a demo day, and on that demo day, then some of the biggest investors in the world are sitting there, and ultimately, if you are good enough, someone's going to want to invest in you. So joining an accelerator is the next level up, which is like you're going to get some funding and you're going to get advice. But the downside is that the valuation is going to be terrible. So ultimately, you'll end up selling 7 to 10% of your business, for equivalent of like $50,000 to $70,000, which essentially means that you are taking the chance that by joining this thing, it's going to give me such a boost that is worth selling my equity. So with those first two, it's very important to understand that most people, angel investors and accelerators, will only be looking at investing in businesses at a very early stage. Early stage means that you've just hit revenue, and because your valuation, they're not going to be willing to give you that much. The next one is called venture capital. And essentially, this is different. This is for companies that are a bit slightly later in the stage, as in you've figured it out, you're getting some revenue, and now you really want to scale. And venture capital actually is split into two different levels in itself. On one side, you call it seed stage. On the other side, you call it growth stage. So seed stage venture capital firms are firms that invest in businesses, again, at earlier stage, meaning you would probably be less than 5 million in revenue. You could be loss making, that's okay. But the most important thing is that you're growing fast. It's called seed stage because ultimately they're giving you seed money like a plant, and it's going to help you grow. And that's essentially why they call them seed investors. And on the other side, you have growth investors, who essentially will be looking for more mature businesses, normally starting from 5 million revenue up to 30 million plus. And they're looking for businesses that are way more established, are profitable, and you can truly demonstrate how this business is going to hopefully become worth hundreds of millions of dollars, if not billions of dollars. With venture capital, it's very important to note that when they're investing their money, they're expecting like a 5 times return of their money. And they need one of their businesses to become the next Dropbox, the next Stripe, the next whatever, when they're investing. How venture capital physically works is that they go and they raise money from a bunch of people and then they invest that money. So they need to make a return for their investors. And that's why venture capital is a very hard group of investors to raise from, because they have strict guidelines. But the most important thing for a founder to understand, for you to understand, is that you can't be messaging growth stage VCs if you are earlier in your journey. So the reason, if you've ever done outreach or you're trying to get in front of VCs, is because you don't understand the investment thesis of that investor and the stage that they're investing. Investment thesis being, so if someone is investing only in biotech, they're not going to want to invest in your agency. Nobody understands this when it comes to looking for the right investor. So you'll see that this investor put 100 million to this business, and you're like, wow, I wish that was my business, but they just don't do your business. So being able to actually understand, go on their website, look at what sector, what market do they invest in, and then what stage do they invest in. So if you do have a AI startup, you're going to have to look for seed stage tech investors, VCs, and they would want that. But the caveat is seed stage VCs are looking for fast growth. Growth stage VCs are looking for slower growth. But at the same time, you're going to have a lot more mature business to be able to attract them. So that's essentially how, if you're going after the wrong VC, you're raising the wrong money. And look, I raised money from venture capital. The company I raised from is called British Growth Fund. And ultimately, they invest in consumer, which essentially means companies that are directly involved with consumer people. I am that because creators work with us, and then creators have followers are consumers. Also, they like tech, and I have a tech platform, etc. So they're called British Growth Fund. They're my VC. And when I raised from them, which was $11 million, it was because I fit their investment thesis. That's so important. So if you want to raise money, right, you got to get a list of your angel investors that fit your criteria. You could apply to Accelerator, but when it comes to venture capital, if you're seed stage, you need to actually have a hit list of here's 20 firms that invest in exactly my type of businesses. And then you're trying to get your metrics to be good enough so you can go ahead and actually be able to get a meeting with them. And look, there's been some massive businesses that have raised venture capital to become successes, like Slack, Figma, Facebook itself. Those are businesses that went the VC route, just like Jamflow, and gave them capital to be able to invest in growth and get bigger from there. Ultimately, it pays off for the VC, it pays off for the founder. Everybody wins when it goes well. Next up is private equity. Private equity is the next level above, and this level essentially is, the serious money, because private equity, it's normally larger than a venture capital in terms of how much capital they have access to, and private equity is where it goes a bit more wider. So big private equity firms, you know, BlackRock, KKR, these are the big firms, they manage billions of dollars, and they'll have private equity for everything. So they'll have private equity for startups, they'll have private equity for businesses, they'll have private equity for real estate. They have private equity for every type of thing, and essentially the most amount of money that is available. Private equity generally works for way more mature businesses, not in the earlier stage. Example would be Gymshark. They raised from General Atlantic after they'd already done hundreds of millions in revenue. Then you go to private equity to be able to get bigger or ultimately even part sell your business. Private equity is very, very different. Essentially, again, they will have investment thesis, so they'll have who they like, but most private equity would be looking for profitable businesses or insanely standout businesses. So private equity are a lot more reserved. They're not like venture capital where they're looking for 5x plus return. Private equity are happy with a less return, but they want more structured, more organized, more systemized businesses, and they like to take less risk. So you'll only be able to raise private equity if you already have a successful business and you can demonstrate that it's really good. If private equity are coming in, they like to invest in a team and they want to ensure that the investment would be safe. And private equity generally would want to take at least 30 to 40% stake in your business. Venture capital will happily take 10% and come for the ride, but private equity is going to be way more aggressive and way more controlling when it comes to the success of your business. Yes, they will give you a deal where you can get an earnout, which basically means that over the next 5 years, you can slowly sell your shares and you can exit your business. So most founders actually exit the business to private equity. Private equity also come and buy out the venture capital and buy out the angel investors. So private equity are the guys that will come and buy people out and ultimately become your new business partner. You will have to have an investment bank like a Deloitte, a KPMG, who actually help you raise the money, because when you're raising private equity now, it's serious business. No one's going to have coffee with you, a couple of meetings and want to give you some money. They're going to want intense due diligence and they're going to have to follow a process, and it becomes very, very complex to be able to raise money. But if you're a late stage business today, you're a founder, that would be the best way, because you'll end up finding someone that truly believes in your vision and wants to now help you and make it a reality and make it worth hundreds of millions of dollars in years to come. And the very last is what you call trade. This is where you're not raising money from investors, you're actually raising money from other businesses that are essentially bigger than you and want to invest in your business. Perfect example of this would be OpenAI. They raised from Microsoft, but once again, they've raised from trade, which essentially means other businesses. The point with trade is different, right? Like you want to combine your resources with theirs and you want to try to go bigger, better together and ultimately build a bigger business. Because the downside of venture capital and private equity is that they can only give you money and some connections. They don't have any infrastructure. If you raise from trade, they have infrastructure. So essentially, if I invest in your business, tomorrow you could have the infrastructure that I have at my disposal. Similarly with Newtonic, we were able to scale it so fast because as Gemflow invested in Newtonic, which is a trade investment for Newtonic in reality, Newtonic tapped into my infrastructure, which I had already developed, multiple warehouses, supply chain, etc., e-com, content, for us to be able to scale that much faster. And that's ultimately the benefit for a founder to go straight to trade. The downside is that once you have done that, it's very hard to then go and raise from some of the other guys. Because when someone's coming from a trade point of view, they're most likely going to buy you out in full over a 5-10 year period. And most trade deals actually would say that in the agreement. If the business hits certain milestones, they will have the right to buy the whole business out. You wouldn't be able to then say, you know, I'm going to go to some VC and I'm going to raise more money on the side. It won't work like that. So those are the different levels of investment. So in reality, you have to actually understand where you are as a business today. You got to look for what type of investor do you actually want based on where you are. And then you got to go and try to get them. The best way is to raise capital. Yes, you do have to network. You do have to manually try to find people, outreach them, go to events, physically meet like the partners or firms. You can do manual outreach, do very warm to the partners or firms, and people would respond. The other way is a lot of them have office hours that you can actually go to, demo, show your product. And very lastly, the most important will be you can get an introduction. And the way I've done that, go look at the portfolio of a firm, trying to hit one of the founders of those portfolio companies, and you'll be surprised how many people will be willing to help you. From that, if the founder's impressed, they will be like, you know what, I'll introduce you to my investors, no problem, I wish you all the best. And that has happened to me many times. And I guess it's probably worth saying as well that if you had the money, you could bring a firm on to help you raise, and they normally have the connections. Anyway, look, my name is Shan. I make 2 to 3 videos every single week. Make sure you subscribe, and I'll see you in the next video.